This is an analysis from Alpha Business Media. Welcome back to the Deep Dive. Today, we are taking a hard, critical look at a strategy that has basically been the default setting for every serious investor I know for the last 3 years. If you've walked into a boardroom in Bishal Nagar lately, or had tea with a family office manager in Naxal any time between, say, 2023 and 2025, the mantra was identical. You know it, I know it. Cash is king.
It was the golden rule.
Yeah.
And honestly, it made perfect sense at the time.
It really did.
I mean, if you look back at that specific window, holding cash wasn't just a defensive move. It was actually profitable. You had fixed deposit rates, FDs, climbing up to 12%.
12% guaranteed.
When you can get that kind of guaranteed return without lifting a finger, staying liquid feels like the smartest move in the room. It felt like a fortress.
That's the perfect word for it, a fortress. You sit inside, safe from the volatility, earning your yield. But the analysis we are unpacking today argues that this fortress is rapidly, and I mean rapidly, turning into a prison.
A prison, that's a strong take.
The core premise here is that in the context of the Nepali market in 2026, the game has fundamentally changed. That dry powder people have been hoarding, it's starting to look less like ammunition and more like a leaking bucket.
Right.
We're going to talk about why cash is becoming a depreciating asset and why everything we thought we knew about distressed real estate needs a serious update.
It's a provocative stance, I'll give it that. But when you strip away the sentiment and you just look at the underlying data, the map is, well, it's brutal. The comfortable era of high-interest cash is ending.
It's over.
And we are entering a phase where the real danger isn't market volatility, it's the silent erosion of what your money can actually buy.
So let's start with the why. Why are the rules changing now? Because for a while there, getting 12% on an FD while inflation was maybe 7% or 8%, that's positive math. You're winning.
You're winning. That's the key.
Yeah.
That's why it was so rational. But you have to look at the global macroeconomic pivot happening right now in 2026. We aren't an island, economically speaking.
Not at all.
The world's major central banks, the Federal Reserve in the U.S., the ECB in Europe, they are signaling that the war on inflation is mostly over. They are stabilizing rates and explicitly looking to cut.
And when the Fed moves, the world moves. But I think some listeners might wonder, does a rate cut in Washington, D.C. really impact a bank manager in Kathmandu immediately?
Eventually, yes. Absolutely. The Nepal Rashtra Bank, the NRB, doesn't operate in a vacuum. We have a pegged currency with India. We are hugely import dependent.
Right.
As global pressure eases, the NRB will inevitably follow suit. They have a mandate to stimulate credit growth domestically. To do that, rates have to come down. So those double-digit FD returns,
They're a history.
they're going to vanish.
Yeah.
The nominal return on your cash is going to drop.
Okay, so let's play devil's advocate. I earn a little less interest. Maybe it drops to 8%. Is that really a crisis? I'm still safe, right? I mean, 8% is still better than zero. It feels like I'm still making money.
See, that's the trap.
Yeah.
That is exactly the trap. This is where it gets dangerous for the unprepared investor. This is the core fallacy of the cash is king mindset in 2026. We need to distinguish between two very, very different types of inflation. You have CPI and you have API.
CPI is the Consumer Price Index. That's the stuff we hear about on the news every month. The cost of lentils, petrol, rent.
Correct. And that's what everyone watches. It's the headline number. But think about the target audience for this analysis. High net worth individuals, corporations, serious investors.
Right.
They aren't hoarding millions of rupees just to buy more lentils. They aren't trying to secure a lifetime supply of petrol. They are trying to buy assets.
They want land, factories, businesses.
Hydropower projects, you name it. They want a piece of the economy.
So you're saying the inflation that matters to them isn't the price of rice, it's the price of a commercial plot in the Terai corridor.
Exactly. That is asset price inflation, or API. And here's the brutal math from the source material. Let's say you are still getting an 8% return on your cash in 2026. You might tell yourself, great, I'm beating 7% CPI inflation. You feel richer. But meanwhile, commercial land in prime corridors is appreciating at 20% a year. The cost to acquire a hydropower project has gone up 15%.
So your cash is growing by 8%, but the thing you actually want to buy is growing by 20%. The finish line is moving away from you faster than you can run.
You are losing purchasing power every single day you hold cash. It's at a negative real return. Cash provides this illusion of growth because the number in your bank account is getting bigger.
Sure, feels good to see that.
But your ability to actually acquire a slice of the economy is shrinking fast.
That's a crucial distinction. It's the difference between being able to afford dinner and being able to afford the restaurant.
That's a perfect analogy. And for the last few years, people could afford the restaurant. Now, they're getting priced out while sitting on a pile of cash, wondering why they can't close the deal.
Now, I want to unpack the mechanics of this because the analysis points out that Nepal is, well, it's structurally weird. It doesn't behave like the textbooks say it should.
Not at all.
In a lot of developed economies, like the US or UK, when interest rates are high, asset prices usually drop. It's a seesaw. Rates go up, housing prices cool down because mortgages get expensive. But here, that just doesn't seem to happen. Why?
It comes down to structural engines that are, well, pretty unique to Nepal. We don't have the same pressure valves that other economies have. The analysis identifies 3 specific engines that drive this asset inflation, regardless of what interest rates are doing.
Let's break them down. Engine number 1 is what they call the closed loop.
Right. Imagine you have a massive amount of capital sitting in Kathmandu. Where can it go?
Good question.
You can look at the Nepal Stock Exchange, NEPSE.
Mm-hmm.
But let's be honest, it's volatile, and compared to the amount of money flooding around, it's quite shallow. You can't dump 1 billion rupees into NEPSE without completely distorting the market.
Or getting stuck. And you can't easily invest internationally. That door is legally blocked.
Oh.
I can't just open an app and buy the S&P 500 or an apartment in Dubai, not legally.
Yeah. Exactly. It's a closed system. The money is trapped inside the country, so all this surplus capital has to go somewhere to store value. And since it can't go to Wall Street, it is forced into the only tangible, bottomless asset class available.
Land.
Land. It's not just an investment, it's a desperate search for safety. That pushes prices up essentially by default.
It's too much money chasing too few distinct asset classes. Which brings us to engine number 2, supply constraints. And this one feels a bit self-inflicted, doesn't it? This isn't just nature, this is policy.
Oh, it is entirely self-inflicted. Geography is a constraint. Sure, the Kathmandu Valley is getting any bigger, but the bureaucracy is the much bigger issue. I mean, just look at the Kitticat halt.
Just for clarity for everyone, Kitticat is the subdivision of land. The government put a freeze on plotting new smaller parcels a while back.
Right. The intention might have been, policy management trying to stop fragmentation of agricultural land, which is a noble goal on paper.
On paper, yeah.
But the result was simple economics. You halted the supply of legal, saleable plots. Did demand stop? No. So the price of the existing inventory just skyrocketed.
And it's not just plotting, it's permits, environmental clearances, the red tape.
Exactly. It's a bottleneck. If you want to build a new commercial complex, the permit process severely limits the new supply coming onto the market. So you have trapped capital from Engine 1 forcing its way into a market where the government has accidentally capped the supply in Engine 2.
That is a recipe for an explosion in prices.
Epic storm.
And then you had the third engine, which acts like jet fuel, remittance. We always talk about remittance as a percentage of GDP, something like 25%. But how does that specifically drive asset inflation?
Think about the nature of that money. Corporate investment is cyclical. If the economy's bad, companies stop spending. They tighten belts.
They lay people off.
Right. But remittance, it's a steady, non-cyclical flow. It comes in regardless of whether the domestic economy is booming or busting. In fact, sometimes it increases when things are bad at home because families need more support.
And a huge chunk of that goes straight into real estate. It's almost a cultural default. It's the first thing you do when you make money abroad. You buy a piece of land back home.
Correct. It creates a permanent demand floor. It's why land prices in Nepal rarely correct downwards, even when the economy is struggling. There's always a buyer, usually funded by foreign income, waiting to pick it up.
So the analysis uses a great analogy here. It says holding cash in this environment is like standing still on a rapidly accelerating escalator.
It's a terrifying visual, isn't it?
It really is.
Should be. You feel like you're standing still, your bank balance is stable, the number isn't going down, but relative to the destination, which is asset ownership, you are falling behind fast. You're receding into the distance.
So if the fortress of cash is now a trap, what is the escape route? Because we can't just sit here and complain about the problem. The analysis suggests a new strategy focused on hard assets, but it gets specific. Commodities and distressed real estate. Let's start with commodities. Are they telling us to go buy gold bars and bury them in the garden?
No, and they are very clear on this. This isn't about day trading gold on an app or hoarding jewelry. This is about strategic deployment in the domestic value chain.
Okay, so for an industrialist, someone running a factory or a construction firm, what does that look like?
It's operational hedging. If you are in construction or manufacturing, you stop holding cash and start holding inventory. You stockpile steel rebar. You secure copper.
You lock in your costs.
You lock in your input costs today because you know inflation driven by global factors or currency devaluation is going to make them more expensive tomorrow. You are converting depreciating cash into appreciating raw materials.
That makes a lot of sense for a business owner. It's basically pre-buying your future needs to protect your margins.
But what about a regular high net worth investor? They can't exactly store tons of steel in their garage.
No, and this is where the limitations of our market bite us again. We don't have regulated commodity exchanges where you can buy a contract for steel or wheat. We don't have ETFs, so the investor has to find proxies.
Proxies, what do you mean? You buy equity in companies that are linked to commodities. Cement producers, hydropower companies, because energy is the ultimate commodity, or large trading houses. When you buy shares in a cement company that owns its own limestone quarry,
You're effectively buying the commodity.
you're betting on the physical inputs that build the nation.
So you're moving one step removed, but the exposure is the same. You're buying the thing that makes the thing. Okay, let's talk about the second strategy, distressed real estate. Now, when I hear distress, I think of a dilapidated building or a plot of land in a swamp. But the analysis says we need to redefine that word for 2026.
This is a critical nuance. In the West, or in textbooks, distress often means the asset itself has lost value. The neighborhood went bad. The building is structurally unsound. In Nepal, distress rarely means the asset is bad.
So the land is still good, the building is still good.
Exactly. It means the owner is in trouble.
It's a liquidity crisis, not an asset crisis.
Precisely. The opportunity isn't to buy junk. The opportunity is to buy high-quality assets from over-leveraged owners who are facing a cash flow crunch. These are people who maybe borrowed too much during the boom times, expecting that 12% growth to continue forever.
And now they can't service the debt.
They have a diamond, but they need cash now.
And where do you find these deals? It's not like they put a sign up saying, "I'm broke, please buy my building."
It's surprisingly public, actually. You just have to know where to look. Bank auction notices in the daily newspapers.
The fine print pages we usually skip over to get to the sports section.
That's where the gold is. Those notices represent high-quality collateral land, commercial buildings, that banks are auctioning off to recover loans. And the analysis highlights specific targets here. Commercial office space in Kathmandu is a big one.
Why office space? I thought everyone was working from home.
That's exactly why there is an opportunity. Between the work-from-home trends and the construction glut of the last few years, there are vacancies. But the location is still prime. It's still central Kathmandu. An investor with liquidity, that dry powder we talked about, can come in, buy that high-quality space at a fair price, and repurpose it. Turn it into clinics, co-working spaces, even data centers.
So you're buying the dip on the asset class because the previous owner couldn't hold on, and I imagine land on the outskirts is the other target.
Yes, land banks held by speculators. There are a lot of people who bought land on the edge of the valley hoping for a quick flip. Now, the market has slowed. They can't sell quickly. But the bank still wants that monthly interest payment.
And that's where you step in.
If you have the capital, you act as a liquidity provider. You solve their debt problem. And in exchange, you acquire an asset that is structurally destined to appreciate.
I like that framing. You want a predator, you're a liquidity provider. It
Yeah.
puts a necessary function on the role of the investor.
It's essential. The market needs liquidity to clear these debts. If no one buys, the banks get stuck with non-banking assets, the borrower goes bankrupt, and the whole system clogs up. You're actually unclogging the system.
You are part of the cleanup crew.
In a way, yes.
So we have the diagnosis cash is rotting, and we have the strategy buy hard assets. But we always like to look at the crystal ball. How does this play out over the next year? The analysis lays out two scenarios, and honestly, neither of them looks great for the cash holder.
Right. We have the base case, which they assign about a 65% probability to. They call it the muddle-through.
The muddle-through sounds incredibly uninspiring.
It's realistic, though. In this scenario, the NRB lowers rates, but slowly. They're cautious. Credit growth is tepid. The result is that real asset inflation just chugs along at maybe 10–15%.
Okay.
Meanwhile, your cash in the bank is earning maybe 6–7%.
So in the muddle-through scenario, the cash holder just bleeds out slowly. You lose 3% or 4% of your purchasing power every single year.
Exactly. It's a slow erosion of wealth. You don't feel it day to day, but in 5 years, you're significantly poorer in real terms. You wake up one day and realize you can't afford the land you could have bought 5 years ago.
And that's the likely case.
But then there is scenario B, the inflationary shock. This is the 25% probability case.
This is the scary one.
Imagine a geopolitical conflict that spikes oil prices globally, or a bad drought in India that spikes food prices. Suddenly, we are importing massive inflation.
Which we are very vulnerable to given our trade deficit.
Very. Now, the NRB is trapped. If they raise rates to fight inflation, businesses crash because they can't afford the loans. This creates more distress, which, by the way, is actually good for the prepared buyer we just talked about.
Right.
But if they don't raise rates and they let inflation run, asset prices just explode.
So in scenario B, if you are holding cash, you get wiped out. If you are holding assets, you are hedged.
That's the verdict. In scenario B, holding cash is catastrophic. In scenario A, it's just a slow loss. There is no scenario, at least no likely scenario, where cash outperforms the asset market in 2026.
That is a sobering realization. It really highlights the policy gap we have in this country. The analysis touches on this at the end, that the cash is king habit is actually born out of necessity. We just don't have other options.
This is the frustration at the heart of the Nepali market. We are addicted to real estate and cash because we lack modern financial infrastructure. The analysis argues strongly for urgent modernization by Saban and the Ministry of Finance. We need REITs, real estate investment trusts.
Just to define that, a REIT allows me to buy a share of a commercial building, like a stock, without having to buy the whole building myself.
Exactly. It democratizes real estate. It gives you liquidity. You can sell that share tomorrow if you need cash. We also need a regulated commodity exchange, so you don't have to buy stocks in a cement company just to hedge against inflation.
And private equity frameworks.
Exactly. Without these regulated pathways, capital has nowhere efficient to go. It just sloshes back and forth between bank deposits and speculative land bubbles.
It creates this feast or famine cycle. Either the money is dead in the bank, or it's overheating the land market.
It does. And until those structures are built, investors are forced to navigate this manually. You have to be hands-on. You have to be out there buying land, seeking out auction notices, managing physical inventory. You can't just click a button.
So, to wrap this up, the era of the cash king is officially over. The safety of the bank deposit is a mirage because while you're sleeping safe, asset inflation is picking your pocket.
The winning strategy now is active, not passive. It's about identifying illiquidity in others and moving your capital into the physical inputs, land, and commodities that are actually building the nation. You have to get comfortable with being illiquid but asset-rich.
It's a call to action for anyone still sitting on the sidelines. I want to leave our listeners with a thought from the source material that really stuck with me. It says, "The throne is empty, but a new king cannot be crowned without first building a kingdom for it to rule."
That's the challenge. If we don't build the financial infrastructure, the exchanges, the REITs, we are just wandering in the wilderness. But for the individual investor, you can't wait for the kingdom to be built. You have to secure your own castle now.
And on that note, we'll leave you to check your portfolio allocations. Thanks for listening to this deep dive.
Stay strategic.